Imagine spending an entire lifetime building wealth. Maybe you create a business from nothing. Maybe you accumulate investments. Maybe your family owns land purchased generations ago for a fraction of what it is worth today. Then you die, and before that wealth reaches your heirs, the federal government may claim part of it. Today we call this the estate tax. Its opponents have given it a much more emotionally powerful name, the death tax. To supporters, it is one of the few barriers preventing enormous fortunes from becoming permanent family dynasties. To critics, it is an unfair penalty imposed on property that someone spent a lifetime earning. But the modern estate tax is much younger than the United States itself. For most of American history, there was no permanent federal tax on wealth transferred at death from independence until 1916. Washington imposed death-related taxes only occasionally, usually during wars, and then repealed them once the emergency passed. The permanent estate tax emerged only after the country had been transformed by industrialization, concentrated wealth, and a growing fear that the United States was developing its own hereditary aristocracy. But the idea itself is ancient. Governments were taxing inheritances thousands of years before the American Republic existed. Ancient Egypt imposed levies on property transferred after death. Under the Roman Emperor Augustus, a 5% inheritance tax helped finance pensions for soldiers. Medieval Europe developed its own versions. Feudal lords collected payments when estates passed from one generation to another. England later imposed probate fees and legacy duties. The underlying principle was remarkably durable. When ownership changed because someone died, government could claim a portion of the transfer. The American Revolution did not erase that idea, but it did create a political culture deeply suspicious of taxation and inherited privilege. The founding generation had just fought a monarchy. Many Americans feared both concentrated government power and concentrated private wealth. Thomas Jefferson repeatedly warned about hereditary fortunes. A republic, in his view, could not remain genuinely democratic if vast estates passed intact from generation to generation until a small number of families acquired permanent economic and political dominance. Even Adam Smith, one of the intellectual fathers of free market economics, regarded taxes on inherited wealth as less damaging than many other forms of taxation, because the person receiving the fortune had not created it. Yet philosophy did not immediately become policy. The early federal government was small. Most revenue came from tariffs on imported goods and from sales of public land. There was little need for a permanent tax on inherited wealth. War changed the calculation. In the late 1790s, the United States entered the undeclared naval conflict with France, known as the Quasi-War. French vessels were attacking American merchant shipping, and Washington needed money to strengthen the Navy. Congress turned to death in 1797. Lawmakers passed a stamp duty law requiring federal stamps on various legal documents, including papers associated with estates. Probating a will required a 50-cent stamp. Filing an inventory of a deceased person's property required another small payment. Legacies were also subject to graduated charges that increased with the size of the inheritance. The amounts were modest. The principle was not. For the first time, the federal government had inserted itself directly into the transfer of property at death. Then the crisis ended. Relations with France improved, the naval conflict subsided, and Congress repealed the tax in 1802. America's first federal death tax had survived barely 5 years, but a precedent had been established. When war returned, so did inheritance taxation. During the Civil War, the Union faced expenses on a scale the federal government had never encountered. Armies had to be recruited, armed, transported, housed, and supplied. Congress dramatically expanded taxation. The Revenue Act of 1862 imposed an inheritance tax on personal property. Rates depended partly on the relationship between the person who died and the person receiving the inheritance. Close relatives faced lower rates. More distant relatives and unrelated beneficiaries paid more. In 1864, Congress raised rates and added a succession tax covering transfers of real estate. Once again, however, the system was treated as an emergency measure. After the war ended and federal finances stabilized, the inheritance and succession taxes were gradually dismantled. By the early 1870s, they were gone. The same pattern returned during the Spanish-American War. Congress passed the War Revenue Act of 1898 and imposed another inheritance tax, with rates that rose with the size of the transfer. And once again, critics attacked it as a punishment imposed at death. The phrase death tax was already appearing in American political debate more than a century before it became a modern campaign slogan. But something had changed since the Civil War. The argument was no longer only about raising wartime revenue. America had entered the Gilded Age. The country was industrializing at extraordinary speed. Railroads connected markets across the continent. Steel mills transformed cities. Oil, banking, and manufacturing created fortunes on a scale the Republic had never seen. John D. Rockefeller dominated oil refining. Andrew Carnegie built a steel empire. J.P. Morgan accumulated financial power so extensive that private bankers could influence national economic stability. Cornelius Vanderbilt's railroad fortune passed into a family famous for mansions and conspicuous consumption. By the end of the 19th century, an extraordinarily small share of households controlled an enormous portion of national wealth. The inequality was visible everywhere. Industrialists lived in enormous houses while laborers worked 12-hour shifts. Families crowded into urban tenements while railroad and oil fortunes multiplied. The issue was not only money, it was power. Standard Oil could influence transportation rates, weaken competitors, and shape political decisions. Railroad corporations could determine whether farmers could profitably move grain to market. Employers could deploy private security forces against striking workers. During the 1892 Homestead strike, Henry Clay Frick brought armed Pinkerton agents into a confrontation with steelworkers. 10 people died before state militia restored control of the area. To progressive reformers, these were not simply examples of successful capitalism. They were warnings. The country appeared to be creating dynasties. If enormous fortunes passed intact to children and grandchildren, then wealth accumulated by one generation could become political power for generations that had done nothing to create it. The Vanderbilts were already moving into their second and third generations of extraordinary wealth. The Rockefellers were developing structures to preserve family assets over long periods. America had rejected hereditary titles, but critics feared it was recreating hereditary power through money. Theodore Roosevelt became one of the most prominent voices demanding action. Roosevelt was hardly hostile to wealth itself. He came from a privileged New York family and defended private enterprise. What concerned him was concentrated wealth so large that it could challenge democratic institutions. In his 1906 annual message to Congress, Roosevelt called for a graduated inheritance tax on enormous fortunes. His argument was straightforward. Society gained nothing from allowing gigantic estates to pass intact from one generation to another. By 1910, in his new nationalism speech in Osawatomie, Kansas, Roosevelt sharpened the point. At a certain scale, he argued, wealth became more than wealth. A gigantic fortune carried influence over politics, industry, labor, and public life. Its danger came not simply from how many dollars one person possessed, but from the power those dollars represented. Roosevelt left office without achieving a permanent federal estate tax. But the political environment continued moving toward him. In 1913, the 16th Amendment was ratified, giving Congress clear constitutional authority to impose a federal income tax. That transformed federal finance. For generations, Washington had depended heavily on tariffs. Now it possessed a powerful new source of revenue based on income. 3 years later, another crisis accelerated the transformation. Europe was at war. World War II disrupted international trade, reducing tariff revenue at the same moment the United States was increasing military preparedness. President Woodrow Wilson's government needed more money. Congress responded with the Revenue Act of 1916. The law expanded federal income taxation, and inside it was something America had never maintained before: a permanent federal estate tax. Unlike earlier inheritance taxes, which focused on what individual heirs received, the new system taxed the estate itself before its assets were distributed. The first $50,000 was exempt, meaning the tax applied overwhelmingly to wealthy families. Rates began at approximately 1% and climbed progressively, reaching 10% on estates exceeding $5 million. By later standards, those rates were modest, but the precedent was enormous. For the first time, the United States had decided that taxing wealth at death would not disappear when the war ended. The estate tax had stopped being an emergency measure. It had become part of the permanent architecture of the federal government. And almost immediately, the battle shifted from whether such a tax should exist to a far more explosive question: how much of the largest fortunes should the government be allowed to take? Once the federal estate tax became permanent in 1916, the argument changed. The question was no longer whether Washington had the right to tax wealth at death. The question was how aggressively it should do it, and almost immediately, the rates began to rise. When the United States entered World War II in 1917, Congress increased the top estate tax rate to 25% on the largest fortunes. A year later, lawmakers adjusted the structure again and widened the tax base to include assets such as certain life insurance proceeds and jointly held property. The government had discovered something important. The estate tax was not just a source of wartime revenue. It was a tool for reaching wealth that might otherwise escape taxation entirely. In 1924, Congress raised the top rate to 40% and added a federal gift tax. The logic was obvious. If wealthy families could avoid estate taxes simply by transferring property to their children before death, then the estate tax would be nearly meaningless. A gift tax closed part of that escape route by taxing certain large transfers made during life. Then came the Great Depression. Federal revenues collapsed while demands on government exploded. Unemployment soared, banks failed, public anger toward concentrated wealth intensified, tax policy moved sharply in a more progressive direction. And by World War II, the federal estate tax reached its historical peak. Beginning in the early 1940s, the highest marginal rate climbed to 77%. That figure sounds astonishing today, but it is important to understand what it actually meant. The 77% rate did not apply to every dollar in an estate, and it did not affect ordinary families. It applied only to the portion of the largest estates above extremely high thresholds. Most Americans never came close to paying federal estate tax. In many years, only a small percentage of all estates owed anything at all. The system was designed to target the very largest concentrations of inherited wealth. For nearly 4 decades, that was the basic philosophy. A person could become extremely wealthy in America. But passing an enormous fortune intact to the next generation was supposed to be more difficult. This was the principle Theodore Roosevelt had argued for decades earlier. The purpose was not necessarily to prevent people from becoming rich. It was to prevent wealth from becoming permanent political inheritance. During the period when estate tax rates were highest, from roughly the 1940s through the 1970s, the United States also experienced one of the broadest expansions of middle-class prosperity in its history. Income inequality narrowed, home ownership expanded, college attendance increased. Union membership remained strong. Public investment in infrastructure and education grew. The estate tax did not create all of that. Many forces were involved: progressive income taxes, strong labor unions, wartime mobilization, the GI Bill, rapid productivity growth, affordable housing, and massive government spending. But estate taxation formed part of the broader architecture. It slowed the automatic accumulation of dynastic wealth. It also encouraged philanthropy. Charitable donations could reduce the taxable value of an estate, giving wealthy families a strong financial incentive to donate money to universities, hospitals, foundations, museums, and other institutions before death. That incentive helped shape American philanthropy. But wealthy families did not simply surrender. They adapted, and some adapted far better than others. The Vanderbilt family offers one famous example of what happens when enormous inherited wealth is poorly preserved. Cornelius Vanderbilt died in 1877 with one of the largest fortunes in American history. His son, William Henry Vanderbilt, expanded it even further. Later generations became famous for something else. Spending. They built enormous mansions in New York and Newport. They hosted extravagant parties. They maintained lifestyles designed to imitate European royalty. The fortune fragmented among descendants. Taxes played a role, but so did lavish consumption, weak investment decisions, family divisions, and the simple mathematical problem of dividing wealth among more heirs with each generation. By the 20th century, the Vanderbilt fortune had largely disappeared. When Gloria Vanderbilt died in 2019, the estate associated with her was tiny compared with the vast fortune created by the Commodore more than a century earlier. Her son, Anderson Cooper, has often spoken skeptically about inherited wealth. The family name survived, the fortune did not. The Rockefellers took a very different approach. John D. Rockefeller understood that the tax system was changing. Rather than simply leaving his fortune as one giant estate, he distributed enormous sums during his lifetime through philanthropy, trusts, foundations, and other structures. By the time he died in 1937, the estate passing directly through probate represented only a fraction of the wealth he had once controlled. The family had built machinery for wealth preservation. That machinery became increasingly sophisticated throughout the 20th century. Lawyers, accountants, bankers, and tax specialists developed an entire industry dedicated to reducing estate tax liability. The ultra-wealthy learned that the estate tax was not simply a rate printed in the tax code. It was a planning problem, and planning could change everything. Trusts became one of the most powerful tools. Assets could be transferred into legal structures that separated ownership, control, income, and inheritance in ways that reduced or delayed taxation. Some of these mechanisms became extraordinarily complex. Grantor retained annuity trusts, commonly called GRATs, became one of the most famous examples. The basic idea is surprisingly simple. A wealthy person places valuable assets into a trust. The trust pays the original owner an annuity for a defined period, effectively returning much of the initial value. If the assets grow faster than a government-set assumed rate during that period, the excess appreciation can pass to heirs with little or no additional gift tax. Imagine placing $100 million worth of stock into such a structure. If the stock grows to $130 million while the trust operates, much of that $30 million in appreciation can potentially pass to descendants under favorable tax treatment. Used repeatedly with rapidly appreciating assets, the technique can transfer enormous amounts of wealth. Other families use dynasty trusts. These are designed not merely to transfer wealth to children, but to preserve it across multiple generations. In jurisdictions that allow extremely long-lived or perpetual trusts, assets can remain inside the structure for decades or even centuries. Investments continue growing. Descendants can receive distributions, but the underlying capital may avoid repeated estate taxation at each generation. This reverses the basic principle the estate tax was created to enforce. Instead of wealth being taxed each time it passes from one generation to the next, the assets can remain inside a legal container designed to outlive every individual beneficiary. The scale can become extraordinary because compound growth works relentlessly over time. A trust beginning with tens of millions of dollars can become worth hundreds of millions after several generations. Begin with hundreds of millions or billions, and the potential becomes difficult to comprehend. Family limited partnerships, charitable trusts, foundations, insurance structures, and specialized holding companies add further layers. The result is a paradox. The estate tax has a high headline rate, but the people with the greatest ability to pay it often have the greatest ability to avoid it. That contradiction gradually transformed the politics of the tax. Supporters continued to defend the estate tax as a safeguard against aristocracy. Opponents increasingly attacked it as unfair. They argued that the same wealth might already have been taxed when it was earned through wages, business profits, dividends, or capital gains. Taxing an estate at death, they said, amounted to double taxation. They also argued that the law could threaten family farms and closely held businesses whose value might be concentrated in land or equipment rather than cash. If an estate owed a large tax bill, heirs might theoretically be forced to sell part of the business to pay it. Whether that situation was as common as political rhetoric suggested became a matter of fierce debate, but the argument was emotionally effective. Then political strategists discovered that language could matter almost as much as policy. For decades, the law had simply been called the estate tax. That term sounded technical and distant. Most Americans did not think of themselves as possessing an estate. During the 1990s, conservative political messaging increasingly popularized a different phrase, the death tax. The change was brilliant. Everyone has an estate only in the legal sense. Everyone dies. Calling it the death tax transformed an obscure levy affecting a tiny share of wealthy households into something that sounded universal. The government was no longer taxing large inherited fortunes. It was taxing death itself. Public opinion became easier to mobilize. The political campaign culminated under President George W. Bush. In 2001, Congress passed legislation gradually reducing estate tax rates while raising the amount that could be inherited tax-free. The changes led to an extraordinary outcome. For 1 year, 2010, the federal estate tax disappeared entirely. A billionaire who died that year could theoretically transfer an enormous fortune without federal estate tax. George Steinbrenner, the longtime owner of the New York Yankees, died during that window, and reports estimated that his heirs avoided hundreds of millions of dollars in potential estate taxes. Then the tax return its structure continued changing, but one broad pattern remains. The exemption grew dramatically. As the exemption increased, fewer and fewer estates became taxable. The tax still existed, but it increasingly applied only to the very wealthy, and even their sophisticated planning could reduce the amount actually paid. Another provision made inherited wealth even more powerful. It is called stepped-up basis. Imagine someone buys land for $10,000. Over several decades, the land rises in value to $10 million. If the owner sells it during life, the difference between the original purchase price and the sale price can create a massive capital gain. But if the owner holds the land until death, the tax system can reset the asset's cost basis to its market value at that time. The heirs may now be treated as though they acquired the property for $10 million. If they sell it immediately for the same price, there may be little or no taxable capital gain. Decades of appreciation can escape income taxation. That creates a remarkable possibility. Wealth can increase enormously during a person's lifetime without ever being taxed as a realized capital gain. Then the asset can pass at death with a new basis. And if the estate itself falls below the exemption or has been structured effectively, the estate tax may also be minimal. A fortune can grow, it can transfer. And much of the appreciation may never face the kind of taxation ordinary wages encounter every paycheck. That brings the estate tax debate back to the question that created it. What happens when wealth becomes hereditary power? Supporters argue that large inheritances undermine equal opportunity. A child born into a billionaire family begins life with access to education, property, investment capital, political networks, and security that no amount of personal effort can reproduce for someone born poor. At some point, they argue, the difference stops being simply financial. It becomes structural. Critics answer that private property means little if government can decide that accumulated wealth becomes unacceptable after death. If someone built a business legally, paid taxes, created jobs, and saved wealth, why should government prevent that person from giving it to children? Both arguments reach beyond taxation. They describe competing ideas of America. One emphasizes individual property rights and family autonomy. The other emphasizes equality of opportunity and protection against hereditary concentrations of power. The estate tax sits directly between them. That is why it survives. And that is why politicians have been fighting over it for more than a century. The tax was never really about death. It was about what happens after death. Specifically, whether enormous private fortunes should be allowed to reproduce themselves indefinitely across generations. Theodore Roosevelt feared that unchecked inheritance would eventually create an American aristocracy without titles. The families would not be called dukes or barons. They would simply possess enough wealth to exercise power that ordinary citizens could never match. More than a century later, the argument remains unresolved. The estate tax still exists. So do the fortunes it was designed to restrain, and the central question remains exactly what it was in 1916. How much inherited power can a democracy tolerate before wealth stops being merely private property and begins shaping the republic itself?